Investors feel that a trade war is now put on hold after some agreements between the U.S. and China. Coming as a new CBS poll shows that President Trump is getting credit for the robust U.S. economy. 18% of voters are now rating the economy as very good, while 46% say it is somewhat good. 35% believe the president's policies are a great deal responsible for America's economic success. And joining us right now to talk more about that is Investmark Advisory Group Principal Michael Lee with $700 million under management. Michael, good to see you. Thanks so much for joining us.
How are we doing?
You're pretty bullish on this economy as well.
Yeah, everywhere I look, it seems not only things are good, but they continue to get better. So you look across the consumer comfort, consumer confidence, consumer sentiment. You look at the job market. Look at the rolling 4-week average of jobless claims. Like, it's the lowest it's been basically on history or record, and that's not adjusted for population growth. You look at things like the quits rate at multi-year high levels. You look at the jolts at the highest level it's ever been. So everywhere I'm looking, it seems to me that not only things are good, but they continue to improve. And you haven't really seen the effects of the largest deregulatory event in the history of the United States, in addition to the largest fiscal stimulus we've ever had.
Is that a reason to put money into stocks right here?
Yeah, absolutely. Absolutely. I don't look. People are going to say, well, stocks may be slightly expensive, but the thing is, what you need to remember is you can look at the PE multiple, and on a forward basis, we're looking at 16 and a half, 16, somewhere along those lines. In 1999, we got to 24, and what happens is the long-term average of the PE is like a 14 to a 15, somewhere in there, and we're either way below it or way above it. And in expansionary times and in growth times, we get way above it. So people calling for and looking for a recession, I don't know what they're looking at or where that would come from.
So one of the things that I look at, too, in addition to the polls that you're talking about, is how people are feeling about the market. So while people feel very, very good about the economy, they're also still very, very nervous about their retirement savings and about volatility. And so my concern is then what happens if there's reason for people to be concerned, if China does go into a trade war and other things. What do you think about the fact that people are so nervous? Because emotional investors don't necessarily make the best decisions.
Well, what I would say, the fact that everybody's so nervous and that hesitancy is precisely the reason why we're not or anywhere near a top. The consensus is never always right? So if we're at the top of the market or we're about to go into a recession, this will literally be the first time where everyone's been right.
Yeah, it's like the saying, Steve, stocks climb a wall of worry.
Yeah, no, it's a good thing. Do you worry a little bit about the Federal Reserve throwing cold water on this and the idea that the economy is overheating and that kind of nonsense? Do you think they're going to try to tamp this thing down as it starts to pick up steam?
I think the Fed is way behind the 8 ball, right? So you look at where the short end, the front end is right now, Fed funds are. We're at 175, right? For us to be at a neutral standpoint, we need to get to close to 275 or 3. So 5 or 6 more rate hikes from where we are right now to begin to even start slowing. And we still have a $4.3, $4.4 trillion balance sheet. So for the Fed to have a material impact in slowing down the economy, they would need to raise rates 8 or 9 times. We're looking out 2 to 3 years. It's so far away from where we are right now. And I would actually say that these next few rate hikes will be stimulative and inflationary in that borrowers in the front end and short-term investors and conservative investors are going to actually start to get some sort of interest, and we're already starting to see that in the economy.
But, Dagan, you brought this up in the past. The Journal this morning is reporting that U.S. government bonds are now paying more than debt from other developed nations for the first time in roughly 20 years. This coming as the 10-year yield is hitting new highs. 3.08% is where we are right now.
Right, it hit 3.122% last week. We're coming up on the 2-year anniversary of the low on the 10-year yield. It was down at 1.36% 2 years ago this July. We're in the beginning of what appears to be, if you talk to Jim Grant on Maria Bartiromo's Wall Street, what could be a 35-year bear market in longer-term treasuries, potentially. That's how long the bull market's been as interest rates have been declining. The last bear market was a 35-year kind of rise in interest rates and yields. The bigger picture is we also have a Federal Reserve that is unwinding an unprecedented balance sheet. It's going to unwind $420 billion this year, and I don't think any person in the market, as smart as they might be, understands what the implications for that are this year, next year, and the coming years.
Never been done.
Well, what I would say is you think about it, what is the U.S. Treasury and what does that yield represent? It represents the insurance value of the United States economy. And so why are interest rates going higher? It's because for me to stay on the sidelines and not participate in risk assets, I need to be paid a lot more money. So it is somewhat bullish that rates are rising off these ultra lows, right? And anybody that disagrees with that can take a look at Japan. If the insurance value of your country's treasury is worth 1% or negative with inflation, what does that say about the prospects for future growth? So the yield curve steepening and increasing and bonds selling off on the longer end, this is a very positive sign that better times are to come for our economy.
I was just going to say, but that assumes that that's the only reason that yields are up. And quite frankly, when you have the Federal Reserve doing what it's doing in terms of winding down this giant $4 trillion portfolio, there's a lot more at play than just people's optimism about the economy. If you look at Treasury.
Well, I would say that there are some positive factors to rates going higher, particularly with large banks, right, and the velocity of money. If you look at the velocity of the M2 money stock since quantitative easing began, it hasn't really increased. So one of the main goals of quantitative easing just didn't work. And so as rates start to increase and regulation pulls back from the banks, we're going to see the velocity of money increase. So I would say, again, that there are negatives to it, but the positives far outweigh those, and this is good for economic growth.
But real quick, because we just had a GDP report that showed consumer spending was at the slowest pace in 5 years, and there are a lot of people out there who think that we will see a recession in 2020. Real quick.
Well, you know, the only thing that people have to look towards that, the only data point that you can use that is the yield curve inverting, right? And so that's where the short-term interest rates are higher than long-term interest rates, and that's typically an indicator of a recession. What I would say is in this instance, it's completely different than a lot of other times we've seen it, because when you are going towards a recession, when the economy is slowing down and you have a sign of excess, and the yield curve doesn't invert because the Fed's rising on the front end, it's because investors are seeking protection and duration on the long end. We haven't seen that. You're seeing the 30-year sell-off not decrease because of a leading in recession. So anybody that's calling for one in 2020 is just throwing darts at a wall, and there's no data to prove it.
All right, we'll be watching. Michael, great to have your insights.
Okay.
Thanks so much.
Thanks,
Michael Lee joining us there.